While the entire crypto market was busy debating which meme coin was going to 100x this week, two of the most quietly powerful assets in the digital economy just received a signal that most people are going to understand 6 months too late. The question I keep getting is this: why isn't XRP moving faster? Why is HBAR still under $1? And here's the brutal truth. If you're asking that question, you're watching the wrong clock. The institutions building the next financial system are not watching the daily price candle. They are signing infrastructure contracts, clearing compliance departments, and deploying capital in dark pools that never touch a retail exchange. The world missed the signal. Again, let's make sure you didn't. Welcome back to Ledger.Wealth.Network. I am the infrastructure analyst here. We don't chase narratives. We don't celebrate green candles. We follow what the boardrooms are building, because the boardrooms move before the price does, every single time. This is not financial advice. This is a forensic breakdown of the most important dual asset thesis in the digital economy right now. Let's get into it. Let me start with a hard truth that most people in this space are not ready to hear. There are two parallel financial systems being built right now, simultaneously, quietly, and with staggering institutional commitment. Most retail investors think they're choosing between them. The institutions building the next financial world know they need both. Here's what I mean. The global financial system has two core problems that no single chain can solve alone. The first is movement. How do you transfer value across borders, across currencies, across time zones, instantly and cheaply? The second is representation. How do you take real-world assets, securities, bonds, payroll, commodities, and make them programmable, auditable, and composable on a digital ledger? These are not the same problem. They require different architectures, and two chains have been built from the ground up to solve one each. XRP and the XRP ledger were engineered for movement. Fiat in, XRP bridge, local currency out. 3 to 5 seconds. Fractions of a cent. No correspondent bank taking a fee at every hop. Ripple's on-demand liquidity product is already deployed across 300-plus financial institutions in 45 countries. That is not a white paper promise. That is live infrastructure processing real transactions right now. Hedera was engineered for representation. When a global bank wants to tokenize a treasury bond, when an enterprise wants to settle payroll on-chain, when a regulated securities platform needs provable transaction ordering that satisfies best execution rules, they cannot use a chain where validators can reorder transactions for profit. They need Hedera's leaderless ABFT hash graph. No mempool, no MEV. Consensus timestamps that are mathematically fair. Sub-3-second finality. Over 10,000 transactions per second. Compliance ready from the protocol layer up. Here is the part that most crypto channels completely miss. These two architectures are not in competition. They are complementary layers. XRP moves the money. HBAR moves the assets. And the interoperability bridge connecting them is already being discussed at the highest levels. Hedera's CEO confirmed that Hedera, Ripple, and Algorand are founding members of a cross-chain interoperability initiative. His framing: imagine if every website had a different protocol and needed a different browser. That would be a nightmare. The industry is building a single protocol, and the two assets at the center of that protocol are XRP and HBAR. Let's talk about the math that the retail crowd is not running. The global cross-border payments market processes approximately $150 trillion annually. The Nostro and Vostro accounts that banks maintain to pre-fund those payments. Essentially capital sitting idle in foreign accounts just waiting to facilitate transfers. Lock up an estimated $27 trillion in dead capital at any given moment. Ripple's on-demand liquidity eliminates that pre-funding requirement entirely. Instead of parking $27 trillion in idle capital around the world, banks use XRP as a bridge asset. XRP acquires on one side, transfers in seconds, liquidates on the other. The capital is freed. The settlement is instant. Now here is where the math gets serious. For XRP to serve as a credible bridge asset and even a modest slice of that $150 trillion annual flow, the market cap of XRP needs to support the liquidity velocity required. Think about it this way. If you want to move $1 billion through a bridge, the bridge needs to be wide enough to handle that volume without catastrophic slippage. A low price means more tokens used per transaction, which means more market impact, which means worse execution. A higher price means fewer tokens required per transaction, tighter spreads, more efficient movement. This isn't a prediction. It's a design requirement. On the HBAR side, the math looks different, but the conclusion rhymes. The tokenized real-world asset market is projected to reach $4 trillion in the near term, with some estimates extending towards $16 trillion by the end of the decade as BlackRock, Franklin Templeton, and Fidelity accelerate their on-chain asset programs. Hedera currently hosts a significant share of tokenized RWA value. The Hedera token service is already processing stablecoin, deposit token, and bond tokenization for enterprise clients. A network governed by Google, IBM, Deutsche Telekom, Standard Bank, Nomura, and 44 other global enterprises, processing regulated financial instruments with institutional-grade compliance architecture, trading under 10 cents. Ask yourself this brutal question. Does that price reflect the infrastructure? Or does it reflect a retail market that still hasn't done the reading? I know the answer. The institutions accumulating right now know the answer. And by the end of this video, you'll know it too. Let's look at what the smart money is actually doing, because actions tell you more than prices ever will. 7-spot XRP ETFs are now live and tracking. Cumulative inflows have crossed $1.44 billion. These are not retail investors clicking buy on Coinbase. These are institutional allocators, family offices, and compliance-cleared funds deploying capital through regulated wrappers because they now have the legal clarity to do so. Ripple completed its acquisition of Hidden Road, a prime brokerage firm that clears over $3 trillion in transactions annually, giving Ripple direct access to institutional client infrastructure and positioning the XRP ledger as a post-trade settlement layer for traditional financial counterparties. That is not a partnership announcement. That is a structural merger of crypto-native rails with institutional clearing infrastructure. On the Hedera side, McLaren, one of the most recognized brands in global motorsport, is not just a sponsor. McLaren is a Hedera governing council member. Their digital collectibles platform, MCL Collect, is live on Hedera right now, running free mints every race weekend of the 2026 Formula One season. Millions of fans interacting with Hedera infrastructure without needing to understand a single thing about hashgraph consensus. That is how mass adoption actually happens, not through white papers, through experiences. And then there's Agent Lab. Hedera just launched a fully integrated browser-based development environment for building AI agents on-chain. No code, low code, and full custom options. This matters more than most people realize because AI agents are the next major class of financial actor. They need to transact autonomously, instantly, and cheaply. They cannot open a bank account. They cannot sign a wire transfer. They need a settlement layer that runs 24/7, costs fractions of a cent, and provides fair, provable transaction ordering. Hedera is the only enterprise-grade network purpose-built to serve that use case. Meanwhile, on March 17th, the SEC and CFTC jointly classified both XRP and HBAR as commodities, binding regulatory confirmation, not securities, not subject to the strictest registration requirements. Both now sitting under CFTC oversight, with reduced compliance friction for institutional capital deployment. While retail investors debated the ruling on Twitter, institutions updated their investment policy statements and increased their allocation limits. That is the gap between the two markets. Here is where the timeline compresses. The Digital Asset Market Clarity Act is moving through the Senate Banking Committee. Brad Garlinghouse publicly forecasted passage by end of May. If that holds, both XRP and HBAR operate inside a fully codified federal regulatory framework before Q3. That is the moment that the compliance departments of the world's largest asset managers stop saying, pending regulatory clarity, and start wiring capital. A Canary Capital Spot Bar ETF is already filed. The commodity classification is the prerequisite. The filing is complete. The pathway is now procedural, not structural. The 2026 F1 season is underway, meaning McLaren's Hedera-powered collectibles platform is actively onboarding new users every single race weekend. 14 races left in the season, 14 activation cycles, each one pulling mainstream attention into the Hedera ecosystem. And Ripple's ODL network continues expanding. Every new corridor, Every new financial institution, every new country adds transaction volume, adds settlement demand, adds utility to the bridge asset underneath. The catalysts are not hypothetical. They are dated, they are filed, and they are live. The window between catalyst and price recognition is the window you're sitting in right now. Here is the structural reality of what you're looking at. XRP has a fixed supply of 100 billion tokens. Circulating supply sits around 57 billion. Exchange reserves are at multi-year lows as institutional custodians move holdings off retail platforms. The escrow system releases 1 billion tokens monthly, the majority of which Ripple relocks. The liquid float available to retail markets is shrinking, not growing. HBAR is trading under 10 cents. Governed by 49 global enterprises across every major industry and continent. Commodity classified. ETF filed. AI infrastructure launching. McLaren live. Enterprise adoption across tokenized securities, payroll, and stablecoin settlement. The boardrooms already made their decisions. They positioned before the price chart told the story. That's how it always works. By the time retail recognizes the signal, the entry is gone. The window that exists right now is the gap between institutional conviction and public visibility. That gap is measured in weeks and months, not years. If you made it to this point, you are not the average crypto participant. The average participant is watching price tickers and listening to influencers who have never read an SEC filing or analyzed a governing council structure in their life. You are doing the work. You are following the infrastructure, not the narrative. You understand that XRP moves the money and HBAR moves the assets, and that the global financial system needs both functions to complete the migration on-chain. The regulatory foundation is done. The institutional validation is live. The AI infrastructure is launching. The interoperability layer is being built. The math points in one direction. Comment full stack below if you made it to the end. I want to know who in this community actually understands what's being built. In a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss, while calm analysis leads to victory.